and welcome to the Mutual Fund Show. We have a new launch from the Kotak Mutual Fund House called the Kotak MNC Fund. Harsha Upadhyay, CIO Equity of Kotak Mahindra, joins in to talk to us more about this new offering. Hi Harsha, thank you for taking out the time to talk to us today. I believe you have a new offering called the Kotak MNC Fund. You want to start by telling us what is the primary objective of this fund and how does it differentiate from the other equity funds in your portfolio?
Sure. As the name suggests, this fund will be a thematic fund investing predominantly in multinational companies. So as per the asset allocation, at least 80% of the assets would go into investing in multinational companies. And it's an open-ended equity fund. It's already open from 7th of this month as a new fund offer and will be closing on 21st of October going forward. So this is a fund which is a thematic fund and suitable for those investors who look for a stable kind of a product, since most of these multinationals have been established companies in their own sectors and have weathered a lot of downturns and business ups and downs in the past several decades. We believe that at this current juncture, when valuations are at the higher levels, this is something which will add to stability in the portfolios.
Harsha, given the focus on MNCs, what criteria will you be using to select companies for this fund? Is it a specific industry, a specific geography, or a specific sector that you would be inclined towards?
The way we have defined the multinational companies, it would comprise of three different segments. The first segment would be those companies which are promoted by foreign companies where the foreign promoter has more than 50% shareholding. So essentially, subsidiary companies of foreign multinationals, but listed in India. The second segment would be the joint ventures of foreign companies. Those would also be available for investing. And the third segment would be Indian-owned, Indian-listed companies. However, they may have exports revenues of more than 50% by exporting into regions outside India, or they may have manufacturing locations abroad, and collectively that percentage is, if more than 50%, that also qualifies to be a multinational company. So essentially, this is how we have defined MNC. And number of sectors are available for investing here. There are at least about 15 different industry segments that are available for investing. And I would say it's a subset of any diversified fund, wherein we would look to invest only in the multinationals, but otherwise the sectoral choices are as wide as any other diversified fund.
Harsha, how do you evaluate the growth potential of multinational companies in India compared to domestic firms? The fact remains that in a domestic company, there is the home bias, right? And there's a sense and understanding of what happens on ground. With multinational companies, which are sitting outside this country, that job might get harder and probably carry a little more risk, I would imagine.
Sabina, as I mentioned earlier, we would be looking at investing in Indian-listed multinational companies. So to that extent, most of these companies would have a significant business within India. Yes, there is also a segment which is going to be focused on exports, where export revenues are more than 50%. Those companies would be probably dependent on global growth or global market conditions, etc. But it's a good mix of all of these companies. But essentially, India-listed companies. And as far as the growth is concerned, if you look at past growth, they have actually done a slightly better than Nifty basket in terms of market performance and also in terms of businesses. These are essentially businesses which are more stable, one could say, very well-established businesses. The brand equity is very high. Generally, most of these companies have technological superiority over peers in the industry. And by and large, the financial metrics would be of superior profile when you look at multinationals. Their ROE profile, their profit margins, all of these metrics generally are better than other companies that are listed. So I would say to an extent, you are investing in a basket of companies which in the past have had consistent track record in terms of growth and profitability, and have also shown a better resilience through market cycles, both in terms of business performance as well as stock market behavior.
Harsha, would it be fair for me to assume that given the run-up and the froth, some of the markets such as ours, and some complain that we are an expensive market, but we've always been an expensive market, the timing of this fund launch somehow coincides with that? I mean, is there any specific economic trend you're looking to capitalize on as you bring this product to the market, or is it a product that was ready to be launched and hence comes in at this time?
That's a good question, Samina. First of all, as we spoke about, these companies have had consistent track record. So to that extent, timing is not so important. They have delivered across cycles and across market phases in different sectors of the economy. That's point number one. Secondly, when you look at the market backdrop at this point of time, definitely we are also looking at valuations as something which is a bit of a worry, at least for the broader end of the markets. If you believe that valuations are on the higher side, obviously you need to, when you are launching a new fund, you need to keep the possible investor experience in your mind. So to that extent, we wanted to launch something which has flexibility for the portfolio managers to move in and move out of different sectors. Because if it's a narrow theme or a single sector thematic, then obviously come what may, whether the business fundamentals are becoming challenging, or if the valuations are expensive, even then the portfolio manager doesn't have leeway to really move out of that sector. So we wanted to avoid those kind of funds to be launched at this point of time, given the valuations in some of those themes. The second was this offers not only breadth and width in terms of choices, it also gives you a lot of choice in terms of multiple sectors. So that's where we believe that not only you've got a set of companies which are very, very consistent compounders in the past, but also, if need be, one can move from one sector to another, which allows that flexibility to portfolio manager.
Harsha, you know, some may argue that investing in a thematic fund is for an individual investor who has a slightly higher risk profile, because it takes taking two decisions. One is entry and exit. But the thematic fund that you're launching is slightly different, I would imagine. In your opinion, what is the risk profile, or what is your ideal customer base, and how much percent of average risk profile investors should look at allocating to this fund?
For any thematic investments, one should not be putting too much of their investments into this bucket. Although, as I explained, this particular product, while it is called a thematic product, it has a lot more flexibility than a usual thematic fund. But still, I would say maybe not more than 10-15% of your allocation should go into this sort of a fund. And also, the horizon needs to be long-term, as most of the equity investment should be geared for long-term focus. And this also should be for long-term. So if you keep that in mind, I think even at elevated valuations of today's market, this is a reasonable choice, because, as I said, in the past 15 years, for example, MNC index has outperformed Nifty by about 3 percentage points. This is about the past performance. There is no indication or guarantee in terms of what is going to happen in the future. But this superior growth has also come at a much lower volatility, because the beta of MNC index is much lower than even a Nifty index. So this is a combination where likely volatility is going to be much lesser than overall market. And in the long run, these companies are expected to deliver better growth and profitability as compared to the rest of the market. So that's a choice that we are offering investors.
You know, I don't know whether this is a valid question, but I'm still going to ask you. The pool of MNCs available is fairly limited. How do you ensure that the portfolio or the offering is well diversified?
Actually, we have seen the investment choices that we will have. There are about 190 companies today. as per the definition that I shared earlier on the show. 190 companies and more than 15 sectors which are available for investment. So obviously, it is quite diversified. Although it's a thematic fund, it is quite diversified in terms of the choices that are available. And we are confident that we'll be able to pick and choose 40, 50 good companies from this pool of 190 to make a portfolio.
Harsha, what benchmark index will the Kotak MNC fund be compared against? I mean, how do you expect the fund's performance to stack up against the benchmark, and which benchmark?
The benchmark for this fund would be NSE MNC Total Return Index. And since it's an active fund, there is no need for us to really buy only stocks that are part of the index or to the same extent, etc. There is an active choice that we will make in terms of building the portfolio from three segments, as if I have to repeat it again. One, the foreign subsidiaries, which are multinationals. Second, it could be joint ventures of a foreign company. On the third bucket would be Indian-owned, Indian-listed company having more than 50% of turnover coming from exports, or more than 50% of assets being located in regions outside India. So these are the kind of companies that we will look to include in the portfolio.
There will be some amount of currency fluctuations, I would imagine, Harsha, even if it's small. Is that something you're concerned about? Is that something you would be watching out or hedging closely?
Yes, since some of these companies will have operations or assets outside India as well, so there will be some currency-related risks that would be there. But that would be there for every other export-oriented company that you could have in a diversified fund as well. So by and large, I think what we have been doing to mitigate that risk in diversified funds will continue in this fund as well. But I don't think it's one of the big concerns at this point of time. We have to be careful in terms of selecting export geographies or businesses which have a lesser cyclicality than probably than the others. So that's what we will have to do while selecting the stocks in the book.
Also, Ken, I don't know whether this is relevant, but I'll still ask you, would you be sort of consciously making choices between dividend-paying MNCs and those that are, focused on capital appreciation, say?
Definitely, multinational companies by and large have been companies which have had higher average dividend payout, one can say, simply because these are all highly cash generating businesses, and they don't come to market very often. I mean, when have we heard some of these MNCs coming to market to raise further equity, etc.? So to that extent, their ROE profile is very, very strong. Their dividend paying ability and capacity is much higher, and they do pay higher dividends in most cases. So yes, that will be something that will play out as well. So it offers a lot more financial stability as a basket, I would say. And most of these companies also have very low leverage by nature of their high cash generating business. So to that extent, yes, these are superior companies from financial metrics, definitely.
One last question to wrap up this conversation with this fund specifically, and this is for viewers who are potentially considering investing in this NFO. What is the fee structure of this NFO, and are there any exit laws or specific costs that investors should be aware of?
This is similar to any other equity-oriented fund where, as per the SEBI regulations, there are slab-wise total expense ratios that are capped. So there is a ceiling that is prescribed based on how much we collect in terms of money. And on an ongoing basis where the AUM is, that determines the total expense ratio. So there is nothing unusual in this fund. It's similar as any other equity mutual fund.
Right. Harsha, I'm going to ask you a question that is somehow related to MNCs and also very relevant around this time, and that's the Hyundai IPO that a lot of people have gotten excited about. It is an MNC that's going to be listing in India and could potentially inspire other MNCs to, list on our exchanges. What have you made of it? Do you feel like this is an opportunity you would aggressively consider, given the fact that you've launched a fund and you have a pretty significant MNC that's going to hit the street?
Samina, we would be in the middle of the IPO at the time of, middle of NFO at the time of IPO. So I don't think we would be able to participate in the IPO in this particular fund. And anyways, I would not like to discuss our view on the individual companies. But you are right. As we go ahead, we would see more of these foreign promoted companies, which are currently privately held, coming up for listing. There are a couple of them in the pipeline over the next few months. We could also see more Indian companies crossing that hurdle of 50% exports turnover over the next few years, given that our government has been focusing on the policies to promote exports. And companies are also building those capabilities. And there is definitely a space in the global trade and commerce for some of these companies. So definitely, while today we may have about 190 companies as investment universe, I'm sure that over the next couple of years, this universe is only going to increase and make sure that we will have more opportunities for investments.
Harsha, like I said, it'd be unfair if I don't get a view on the markets. I have a little bit of a market conversation with you since we have you on the channel. And at a time when things are looking difficult, markets have been volatile. Of course, the decline on the benchmark might not sound too large because we've been waiting on this impending correction from maybe mid last year. But the fact remains, investors are worried, NAVs are dropping, worries are rampant. Suddenly, China has become a problem we need to talk about. Valuations have always been a concern. How do you feel about the markets right now? Are you using every dip as a buying opportunity, or you think better times are ahead in terms of being a buyer?
See, clearly valuations have been on the higher side, and they have been moving up over the last several quarters as well. So definitely our view remains cautiously optimistic at this point of time. We are probably more comfortable on the large cap side as compared to mid and small cap side, where we believe valuations have become more elevated. And also there are a couple of red flags that we need to look at this point of time. The June quarter results were not so great. June quarter was the weakest after the COVID pandemic in terms of year-on-year numbers, both for large caps as well as mid and small caps. The September quarter, where we will start seeing results coming in now, is also likely to be quite muted. So to that extent, I think the festive season will be critically important to see whether the full year numbers will be achieved or not. And given the fact that valuations are on the higher side, definitely an eye should be kept on earnings growth trajectory from here on. Second is, despite the geopolitical conflict, until about a week or 10 days back, crude was behaving quite benign, and it was even hitting newer lows every day. However, very recently, we have seen a spike in crude oil prices. At these prices, it may not be a concern, but if it continues to move up from these levels and move higher, it will definitely put more pressure on our economy as well as our corporate earnings profile. So to that extent, I think we need to keep these two things in mind, especially given that valuations are on the elevated side.
Harsha, what has been the average cash positions across all your funds up until last week?
Samina, we usually don't use cash as a tool to manage volatility. Even when we are defensive, we would look for opportunities on a relative basis which are looking better and move there. So to that extent, our cash levels have been more or less normal levels at about 2.5% across most portfolios, I would say.
Incremental money that flows in gets allocated. Is that a fair assumption for me to make?
Yeah, it may not be that whatever money comes in today will get deployed tomorrow, but generally we don't try to keep too much cash at any point of time, because the cash is always a double-edged sword, right? While you may feel that you will probably reduce downside if you build cash at an elevated valuation perspective, it may also happen that market may not come down or may go up even further. So to that extent, we don't take those calls. And also, just to give an example, suppose you are looking for a 70% allocation in equity funds, and you have chosen one of our funds as a vehicle, let's say. You have already made a decision that your personal allocation should be about 70% into equity. Now, if we go and create 10% at one point of time, at another point of time, 20% cash, then your allocation, which is intended to be 70%, would be much lower than those numbers, right? That's not something, and each individual investor has already made a decision about intended equity allocation levels. So we can't be changing our cash levels, which will create an anomaly. So to that extent, we make sure that whatever money comes in, the investor has already decided that it should go into equity funds and equity investments. That's the choice already been made. So if that has been made, then our job is easier to make relative choices within available opportunities. That's how we look at overall investments.
Very frequently we say that when the markets are getting tough, and of course, even if they're not getting tough, I think the one advice is to ensure you rebalance your portfolio enough to maintain the asset allocation at the asset level. Of course, we also talk about rebalancing at a product level or at a stock level. Now, most people would say that use this opportunity to, take some positions off the table in overvalued sectors, move to sectors that are undervalued. But the fact remains, value investing currently is a challenge, even if you are a fund manager or a stock picker, retail investor in that sense. I mean, this is advice we gave, but in fact, this is hard to execute. Have you managed to move to sectors or spotted opportunities that others could replicate or, individual investors could do?
See, I think every now and then individual investors and every investor needs to look at asset allocation and see whether there have been any deviations from the intended levels and set it right. So as far as our portfolios are concerned, we keep looking at stocks and sectors to see what was our intended risk level, what are the valuation levels today, what are the growth estimates that are in front of us, is it better, is it turning worse, all of these equations we keep evaluating. And in the past couple of months, we have taken some money out of auto component sector, industrials to some extent. And the profits that were booked from these sectors have gone into slightly more defensive bets, such as IT services and consumption, I would say. So to that extent, yes, our portfolios have turned a little defensive by not creating cash, but by choosing sectors where we believe probably there is not so much of a valuation risk. And also wherever the mandates have allowed, we have moved away from a little bit of mid and small caps towards large caps. That's again because on a relative basis, we find large caps to be a better place at this point of time.
Smaller sector, not smaller actually, sectors that have really not got the best of the markets recently, even though we have seen a bit of a gain coming from metal stocks last month, the fact remains that a lot of managers had started betting on metals, betting on the recovery in China, or the fact that demand will eventually pick up, even though from what I understand, LME inventories remain at record lows. How do you feel about metals and how do you feel about banks? Because if you've got to play consumption, if you've got to play the India theme, one of the pillars of that would be banks, I would imagine.
On banks, clearly, we continue to watch that space while we are still underweight at the sectoral level, but we believe that this is one sector where there is a valuation comfort. If at all there is any sector which is below 2019 valuation levels, that's banking in our opinion. So to that extent, there is valuation comfort. Of course, there are short-term headwinds that a banking sector needs to get over with. So we will be looking at this space very closely to see whether valuations will get further attractive, or if some of those headwinds start to diminish, then obviously that's the time to go overweight on the industry. But clearly, I think this is an industry which cannot be avoided, and we do have reasonable position at this point of time. On metals, it's still a sector which is driven by global factors. So to that extent, what happens to global growth, what happens in China in terms of stimulus and kind of supporting the economy, all of those would be very critical for at least our pricing part of the equation. The only good part is in this cycle, most of the Indian metal companies have cleaned up their balance sheets and they are not as leveraged as they were in the previous cycle. So to that extent, their ability to really manage the downturn is much higher in this period. Given all of this, yes, at this point of time, we don't have a overweight exposure, but it's not that we have completely avoided metals in our portfolio. We do have some small exposures.
Any contra calls?
No, in this market, it's difficult to find contra calls. The banking is probably one space where, yes, there are short-term headwinds. Nothing exciting seems to be happening. However, at least on the valuation side, there is a lot more comfort. So that's something that we have continued to hold in our portfolios.
Well, thank you very much, Harsha, for talking to us, telling our viewers your thoughts on the market, and of course, calming nerves. That's probably are fairly nervous at this stage. And more importantly, good luck with the Kotak MNC Fund. We'll hopefully speak to you soon. With that, we're completely out of time on this edition of the Mutual Fund Show. Thanks for watching.